Welcome back to Factful Finance, where we expose the hidden truths of the financial world. Today we're diving deep into a topic that could significantly affect your future, and it's not as straightforward as you might think. Have you ever wondered what happens when you decide to unlock the value in your home? Should you choose a lifetime mortgage or a home reversion plan? The answer might seem simple, but the devil is in the details. One could give you extra money while you remain in your home, while the other could cost you far more than you expected in the long run. But here's a shocking fact. Over 100,000 homeowners in the UK have used equity release schemes, but many have no idea how they work until it's too late. This video will break down lifetime mortgages versus home reversion plans, giving you a clear picture of which option might be best for you, and why understanding the difference could save you from a costly mistake. Let's get started. Lifetime mortgages, what's the deal? A lifetime mortgage is the most popular form of home equity release in the UK. It allows you to borrow money against the value of your home, with the loan being repaid when you die or move into long-term care. Essentially, you're taking out a mortgage that doesn't have to be repaid until later in life. So, how does it work? Let's break it down. You retain full ownership of your home, which means you can continue living in it for as long as you like. Interest is added to the loan. The interest compounds, meaning you'll owe more over time. Repayment is deferred until you die or move into long-term care. Now, here's the kicker. Because interest compounds, the amount you owe could balloon over the years. For example, if you take out a £50,000 loan at a 5% interest rate, after 10 years, you'd owe roughly £81, and that's just interest. The principal continues to grow as well, leaving you with a much larger debt than you anticipated. Let's look at a real-life example. Imagine Liam, a 68-year-old retiree who takes out a £50,000 lifetime mortgage to fund his retirement. Over the next 15 years, his debt grows due to compounded interest. When he passes away, his house is worth £200,000. The debt, however, is £150,000. His heirs inherit £50,000, significantly less than the home's original value. Home reversion plans, a different approach. On the flip side, a home reversion plan involves selling a portion or all of your home to a provider in exchange for a lump sum or regular payments. Unlike the lifetime mortgage, there's no interest accumulating over time. But here's the catch. You no longer own your home. Here's how it works. You sell part or all of your home to a provider, but continue to live in it for as long as you want. You receive a cash lump sum or regular payments, typically lower than the market value of your property. You don't pay anything back. The provider claims their share of your home when you die or move into long-term care. Now let's look at this with an example. Take Olivia, a 72-year-old retiree who owns a home worth £200,000. She opts for a home reversion plan and sells 40% of her property for £80,000. Over time, Olivia continues to live in her house, receiving her lump sum. When she passes away, the provider sells the home and takes 40% of the final sale price, which could be £80, leaving Olivia's heirs with 60% of the home's value, approximately £120. Which is better? Lifetime mortgage versus home reversion plan. So now that we've broken down the mechanics of each, let's compare them side by side. Ownership. With a lifetime mortgage, you maintain full ownership of your home, but the debt could grow substantially. With a home reversion plan, you sell part of your home, but there's no risk of growing debt. Repayment. The lifetime mortgage is only repaid after death or when you move into care, and interest can really pile up. The home reversion plan has no repayment, but gives you less value for your home up front. Inheritance. If you plan to leave your property to loved ones, a lifetime mortgage might reduce the value of your inheritance due to growing debt. A home reversion plan will also reduce the inheritance as you've sold part or all of the property, but it's a known fixed amount. Here's the important question to ask yourself. What do you value more? If you want to stay in your home and have the option to pass it on to your children, a lifetime mortgage might seem appealing, but it's important to know the debt may far outweigh the value of your home. If you're more concerned with releasing equity for immediate needs and don't mind selling part of your home, a home reversion plan could work better, but again, at a lower payout. Final thoughts. Before making any decision about equity release, it's crucial to have a deep understanding of what's at stake. These are irrevocable decisions, and getting it wrong can lead to unintended consequences. The important thing is to consult a professional, someone who can give you advice based on your specific situation. Remember, this content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. So what's your biggest concern when it comes to equity release? Is it the debt that could accumulate or the idea of losing part of your home? Drop your thoughts in the comments below. I read every single one. If this video opened your eyes to something you didn't know, don't forget to like and subscribe. And if you want to continue exploring more vital topics about protecting your financial future, stay tuned. There's a lot more to uncover in this series. And hey, if you're looking for a deeper dive, this video on how equity release can impact your pension may just be what you need. Click it now, and let's keep the conversation going.